I do continue to believe that there's a path to a soft or softish landing. I do believe that. And
the definition of a softish landing is what? Unemployment goes up a little, but we don't have a recession?
Yeah, unemployment goes up, but it's not a hard landing. It's not a severe recession. You could think of unemployment going up, but not really spiking as it does in some recessions. So that's how I think about it. And I think the path is pretty clear. The labor market conditions soften. We see inflation, and the goods inflation gets better, housing services inflation gets better, and the labor market softens but doesn't go into recession, and you see inflation start to come down. And I think that's very plausible.
So just to boil that down for a second, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that?
All right. Today is Sunday, September 24th, and this is a recap for the stock market activities today. Now, folks, I got a good one for you tonight. What a week it was. Ooh, the Dow Industrial Average was down for the week by almost 2%. The S&P down by almost 3%.
Oh, no.
The Nasdaq down by a little more than 3.5%. And the Russell 2000 down almost 4% in a single week. And it wasn't just bad for the stock market, it was bad for the economy too. You see, inflation is really bad. How bad is it, Maverick? It's so bad that Leo DiCaprio is now raising his maximum dating age to 25 in a month. So this poor lady has, about 20 days left here. It's a pump and dump operation, folks, and it's not just the only one. We got plenty of those pump and dump schemes in the market this week. We got the ARM IPO, and look at this. Oh my God, ARM lost its legs all of a sudden. The stock is now trading below the IPO price. Wow, who would have thought? Then you got the Instacart scam, and of course, the stock is now down, the investors are losing their money, but the founders and the executives are walking away with a lot of cash. And another pump and dump scheme that we got this week is the Collapse IPO. You bought it, you lost money, the CEO walked away a billionaire. Pump and dump, baby. And of course, the retail investor keep falling into the same scams over and over and over again. No street smarts at all. But folks, buckle up here. We're going to take the gloves off and dive right into it here. You see, we're living in an age of propaganda and brainwashing all over the place. You'd think after years, of human evolutionary process, would sniff that kind of stuff, would say, you know what, we're not living in the 1930s anymore. I'm not falling for this propaganda. But you know what? We keep getting dumber and easier to scam and propagandized. And if you listen to the media, all you hear is, oh my God, the economy is fine. Inflation is going down. The stock market is up. There is no recession. There is a soft landing and Goldilocks and pink unicorns and flying dildos. Everything is fine. Everything is beautiful. You get the banksters and BofA, for example, coming out this week saying, oh, don't worry. Be happy. They're now more bullish than ever before on the stock market. Why? Because the economy is doing beautiful. Then you got the zombies at the Fed. They also now say, oh, we're now expecting a Goldilocks scenario. No recession, low inflation, and positive growth, or really. Then you got circus clown Rick Newman from Yahoo Finance. He says that this week in Bidenomics, the great disappearing recession. Oh my God, it disappeared. It went away all of a sudden. It was fake. It was a mirage. Just like we thought back in 07, right? Anyways, then you got a lunatic with the anger issues, Paul Krugman. He says how Goldilocks came to the U.S. economy. She took a cab. I don't know. And then you got the good professor from Wharton, Jeremy Siegel. He says we are in a Goldilocks economy and the Fed doesn't need to raise interest rates anymore. You got strong economic growth, falling inflation. Bye. But folks, in reality, not in lunacy land, but in reality land, the economy is actually horrific right now. You might have heard of the UAW auto strikes, which we covered in details in the last weekend video. And before that, of course, it was the port workers and then UPS. And now, the UAW is not over yet, but other labor unions and workers are now looking at this and saying, you know what? Look at what's going on with the UAW. They strike and they're not the boogeyman anymore. The public is actually supporting the union over auto companies. Gee, why would the public be supportive of unions striking and demanding higher wages, causing disruptions, and then higher prices ultimately on all of us consumers? The answer is because the public now is also getting a taste of this absolutely horrific inflation that never really went away, and it keeps actually getting worse and worse by the day. So now we have more than 75,000 workers of Kaiser Permanente threatening to strike if a labor agreement is not reached. And what is the demand here? Higher wages, and that's inflationary. The economy is so bad right now that even McDonald's is raising royalty fees for new franchised restaurants for the first time in 30 years. Why would they do that? Because the economy is absolutely horrific. Inflation never went away. The input cost continues to go higher. There is no relief. Not before, not now, not inside. And at the same time, the consumer purchasing power continues to go down. So the only remedy right now, even for let's be honest here, a recession-proof company is to raise the rent. And that is a desperate measure. It's a last resort because they have no power in reducing their costs and they have no power in putting money back in the pockets of consumers. At the end, the small business owner who's operating these franchised restaurants, when they do the math and they have to pay McDonald's a higher fee, they have to pay workers now in the state of California higher wages and higher taxes. Is it really worth it doing business at all? Is it really worth it to keep operating a restaurant that continues to lose money? It doesn't make sense at all. And then comes unemployment, closing restaurants, you know the deal. And folks, in this program, we talk about the monetary policy most of the time. But in this video, I want to talk a little more about the fiscal policy and the insanity surrounding this fiscal policy. Reckless spending on steroids, spending like a drunken sailor. Just a few months after suspending the debt ceiling, we're now adding trillions more to the national debt. We're not even 2 months, 3 months since we got a deal, and now we're already racking up $3 trillion? This is unsustainable, folks, as we continue to see interest rates moving higher. And the question now becomes, what will happen if we have economic weakness? And are we going to print more? Are we going to borrow more? Maybe to give out stimmies before the election? And of course, doing that will raise interest rates even higher, higher and higher and higher. Now the government will pay over $1 trillion in interest payments alone. Then what's going to happen? At some point, the government will have to raise taxes by more than 50%, and that's not going to be enough. It has to be 60, 70%. And now, folks, we're dipping into dangerous territory. Overtaxation, burdening the citizen with overtaxation. Not a good move, but what is the remedy here if the pace of spending continues to go to the moon? So let's talk about it here, and we talk about the wall of worry. And the items we have in the wall of worry, the circus in DC, what's going on in Russia, Ukraine, China, the monetary policy, the Bank of Japan, and of course, what's going on in the European Union. We know that Germany is already in a recession. Now it's going to be in stagflation as energy prices rebound. But of course, the most country at systemic risk is Britain. So we continue to watch that. But today we're concentrating on DC and the failure of Bidenomics. How old is Bidenomics, by the way? I don't know, 3 months and it's already collapsing right now? Bad strategy. And I said that from the get-go. You're not going to weasel your way around bad poll numbers by gaslighting us and brainwashing us with propaganda that, oh my God, the economy is doing pretty good. Inflation is going down. It's just in your head now. Bidenomics, it's working. It's doing its job. Well, that's not working, folks. Gee, who would have thought? But of course, now it becomes really complicated, even if you want to be honest with the public and say, look, inflation is bad. We're doing our best here, or we're going to blame it on an external force. Who is it going to be? Blaming inflation on the Trump administration is not going to work out. Blaming inflation on Putin is not working out. Saying that inflation is a global phenomenon is not working out. So what's left here? The Biden administration blaming the Fed about the disasters in the economy? Perhaps. But then if you're going to blame the Fed, you rehired Powell. So there is no escape here. The Biden campaign with the stupid Bidenomics strategy dug their own grave now, and there is no way out of it. Look at what's going on at the polls right now.
Look at this. Donald Trump, brand new national poll of Republican primary voters, nearly 60% support the former president. His nearest rival, Ron DeSantis, more than 40 points behind him now. Obviously, you can see here nobody else in single digits. And look at the movement, too. From the start of the summer, we polled this back in June. Trump seemed to have a dominant lead then. It has only gotten more dominant. From 43 now, it was not even 30 in June. And you can see here, we asked the question. I think this gets to the heart of it. We asked Republicans, should Donald Trump be the leader of your party? And now nearly 60% say yes. It wasn't quite 50 at the start of the summer.
Well, Stephen, what's so stunning about this number, a lot's happened since June. We're talking 2 more indictments against former President Trump, so 4 in total, and the first GOP primary debate. And yet, Mr. Trump is just solidifying his lead with GOP voters.
And Kristen, you know this from talking to Republican critics of Trump, from rival campaigns. Everything you just explained, they thought would take him down a peg this summer. And instead, he has only moved up here. You can see the numbers saying the party needs a new leader. That has gone down. So for Donald Trump there, nothing but good news. And it raises this question. If Republicans go forward and nominate Trump again, this is what the rematch in our poll would look like right now. 46-46. And you remember, in 2020, Joe Biden actually won the popular vote by more than 4 points. And how about this? DeSantis, who sort of pitched himself as the electable version of Trump to Republicans, fares worse against Biden than Trump does. We also tested Nikki Haley, the former UN ambassador. She actually leads Joe Biden by 5 in our poll. But obviously, the fact that the president is struggling this much against every Republican we put him up against raises the question. Where is that coming from? The most obvious answer is just this, a simple question of job approval. Barely 40% approve of Joe Biden's performance.
And we have to note, 56%. That's the highest disapproval rating for President Biden since he took office. That's significant.
Yeah, so let's take a look at what's driving that, too, here. In one big area, no surprise, it is the economy. Look at this contrast. This is April of 21, months after Biden took office. Nearly half the country was satisfied with where the economy was then. Now, barely 1 in 4 Americans satisfied with the economy.
Yep, he's back. And if you thought that was bad, take a look at the poll that we got today from ABC. It was an absolute disaster for the Biden administration. It's going to be the talk of the week. Of course, they're going to dismiss it as, oh, it's an outlier. And it is, but it illustrates an important problem here. Former President Donald Trump, with all of his problems, is leading Biden right now in the recent poll by ABC. 51-42. I mean, that's disastrous. At this stage, at this point, and you're losing by almost double digits here. And folks, it's going to get worse as we head closer to the elections. At some point, this poll is not going to be an outlier anymore. You know why? Because the economy will get worse. We're going to be in stagflation. I mean, I think that we are already in stagflation, or we've been in stagflation for a long time now. It's about to be official that we are in stagflation. And soon enough, we're going to have a recession, perhaps induced by economic weakness or by a systemic/credit event. And it's going to be a disaster. And as the public watches all of that, they're not going to credit the Biden administration. They're going to despise the Biden administration. And whether they like Trump or not, he's going to continue to gain at the polls because, I mean, I'm not a fan of Trump either. I wasn't a fan of Prince Kushner running the show. But if I'm suffering and the bills are going higher and I'm losing my job and I'm paying more for gas and I'm paying more at the grocery store, well, I'm going to blame somebody for this. And who's better to blame than who's in charge right now? And if there is an alternative, if there's somebody who's claiming to be the alternative, and oh, by the way, this alternative has a track record from a previous presidency, maybe not at the end, but at least leading toward the end, the economy was doing pretty good, at least on paper, at least how folks remember. Oh, he's going to gain at the polls. And what's really interesting about all of this, in his announcement speech about a year ago, Donald Trump saw it coming. Take a look.
But the citizens of our country have not yet realized the full extent and gravity of the pain our nation is going through, and the total effect of the suffering is just starting to take hold. They don't quite feel it yet, but they will very soon. I have no doubt that by 2024, it will sadly be much worse, and they will see much more clearly what happened and what is happening to our country, and the voting will be much different. 2024.
So, folks, right now, Bidenomics is collapsing, and it's going to keep getting worse and worse and worse, to the point, if Go back to the ABC poll. Even Democrats are now 62% say that would like to see somebody else but Biden. And why is this stemming from? As the analyst that you just watched said, it's all about the economy. What's specifically about the economy? Here it is. According to the poll, when asked about food prices, 91% of respondents said not so good or poor. When asked about gas/energy prices, 87% said not so good or poor. So it's all about the economy, stupid. And whether you say Bidenomics or not, people are pissed off right now. Whether you say that inflation is cooling down or not, whether you say soft landing or not, whether you say Goldilocks or not, whether you say AI or not, the reality of the economy doesn't match with the hype and the fantasy. If we look at food inflation, it remains a massive global phenomenon. All over the world now, we see food prices going higher and staying higher, even here in the United States, a country that is rich with food. So is it really a surprise that we see 91% of respondents saying that food inflation is bad? And then when you look at gasoline prices, if inflation is going down and it's over, as the Goldilocks zombies say, then why are we seeing this right here? California gas prices near $6 a gallon. It's happening again. Inflation never really went down. It went down in the statistics, but not in reality. In reality, prices are going higher. And now, of course, it becomes, you might have heard the commentary by Chevron CEO, but now many other analysts beside Chevron CEO are saying that oil is heading back to $100 a barrel. But I know what you're going to say. You're going to say, hey, but Maverick, as we head to the elections right now, the Biden administration will do something with Saudi Arabia, and we will see supply coming back in and prices going down. And I told you that's a fantasy because Saudi Arabia right now is an existential threat. Diversify the economy out of the oil industry or die. You might have heard the Saudi prince at Fox News when he was asked about oil prices going higher. He responded with a frank answer. If this means Americans will continue to spend heavily at the pump amid Saudi Arabia's unilateral oil production cuts, then this is simply business in his view, nothing personal. Adding that in 1980, we were number 12 globally in GDP, and in 2016, we are number 20. I'm trying to get Saudi Arabia back on track. And again, Saudi is going to do what's good for Saudi. China is going to do what's good for China. India is going to do what's good for India. Question becomes, is the United States doing what's good for the United States people? Of course not. Maybe they confused the United States with another country that begins with the letter U. Maybe. I don't know. But again, here in reality land, when we see the UAW strike, what do you think that's going to result in? Higher vehicle prices. GM and Ford going to charge us more. Right now, the average price for new vehicles is actually sitting at record highs, and it's not going down really. If you look at the chart, prices are not really going down, and they're about to go higher. So we talked about food prices going higher, and we'll talk about them more in the commodities coverage. We talked about oil prices going higher, and now you got new vehicle prices going higher. And oh, by the way, how about the lag impact of raising interest rates by the Fed? Now rates are higher, and we've been racking all of this debt on credit cards, on loans, or whatever. We're going to have to pay for that at higher interest rates. That is another form of inflation that nobody really talks about. The inflation in interest rate payments. When you look at new car loans, for example, they're going higher. The average loan for a used car also going higher. Almost right now at $600 a month for a used car. This is insane. And when we talk about the disconnect here, why are folks not buying the Bidenomics propaganda? Well, they've been losing to inflation for years now. And there was supposedly a period when wages actually beat inflation this year. But look at the gap, it is closing. You see inflation, the CPI moving higher, but average pay is going down. So again, are we really surprised to see that the public is not happy with the economy and maybe now seeking an alternative, as bad as it may be? When we talk about student loan payments coming back, well, they thought it's going to be permanent because they've used a lot of credit card debt. Borrowers with delinquent student loans increased their credit card debt by 80% in about 2 years, and now they're getting squeezed from both sides. On one side, you got credit card payments. That's going to cost you more and more and more. And then you got your student loans that you have to pay back. So there is no relief inside here. Again, are we surprised to see all of these bad poll numbers? Of course not. Yet what I'm showing you right now is not the fantasy that you see in TV. It is reality, and this is why it's unpleasant right now. And when you see all of these delinquencies that's going on in credit card payments and rates going higher, is it really surprising to see credit card losses now rising at the fastest pace since the great financial crisis? Good times, right? Even credit card companies are now feeling the pain in this great economy, this great Bidenomics economy. And oh, by the way, if you thought that food prices are going higher, that interest payments are going higher, oil prices are going higher, car prices are going higher, but maybe we're going to catch some relief here. Maybe housing prices are going down. Nope, no relief in sight here. If you look at the latest reading here for home prices, year on year, they're moving back up again. We're seeing re-inflation in existing home prices. There is no relief here. Again, are we surprised to see the bad poll numbers? Of course not. And that leads us now, let's talk about the monetary policy if we look back at the wall of worry. Because it ties up. It's all connected here. And of course, you saw what Powell said. He said, yeah, soft landing is plausible. But this week, he kind of threw cold water in soft landing. That maybe due to external forces, he said. Maybe we're going to see the unemployment rate going higher than we expect. He called soft landing a primary objective, and this is why the man is doomed to fail, and when he fails, he's going to fail the economy with it. You gotta take your medicine in life, folks. You gotta be real. You can't live in fantasy land forever. You gotta face the music at some point. You see, Chairman Volcker, when he raised rates, he knew that the outcome will be a recession, and indeed we got 2 recessions, but we got rid of inflation. We got the boom in the 80s and 90s. Why? Because Chairman Volcker knew right away that he gotta tackle this problem immediately with aggression. And if it means a recession, so be it. The economy can recover if you do the job right away. The man was in touch with reality. The man that we have today, Chairman Powell, he's living in a fantasy land. He wants his cake and eat it too. He wants inflation to go down, but without causing a recession. Well, good luck with that. You're pursuing a fantasy right now, instead of doing what we know. In 21, even in 22, had he raised rates aggressively, caused a mini recession, crashed the market by 50%. It was in a bubble anyways. Maybe at this point we would be talking about it's over and the economy begins to recover from here. But because they were too late to the game and too cowardly to do the job and stick with doing the job, every time they pause, they skip, and they take a step back, well, guess what? It's a fight. It's a battlefield right now. And inflation is fighting back. If you back off, allowing inflation to come back, inflation will come back. And this is what we see right now. The problem is the economy is getting weaker, aka we're now in stagflation, which is damned if you do, damned if you don't. If the Fed raises rates right now, they risk a financial accident, they risk a systemic risk event, and of course, they risk hurting the economy even more than it's already hurt. If they do nothing and just leave rates as it is, or even worse, cutting rates, then that is the equivalent of surrender, which will allow inflation to come back with aggression. And we're going to have a massive stagflation problem in the economy. All of this could have been avoided. All of this was preventable. Not anymore. We look at leading economic indicators this week. They continue to go down, pointing out for a strong recession possibility. But of course, the best illustration for a stagflation problem in the economy came out from this week's Philadelphia Fed Manufacturing Index. You see the headline reading, the activities are pointing down. They're going down again, back into negative territory. But prices paid are moving back higher into positive territory. So prices go higher, but the pace of economic activity goes down. That's stagflation right here. And the problem with stagflation, you might want to pay attention now, because we're going to talk about the market. The problem with stagflation is it handicaps the Fed's ability to rescue the economy. You see, if the economy was weakening but inflation was crashing, the Fed can cut rates and re-stimulate the economy again. But if you have the unemployment rate going higher and you have the economy deteriorating, but inflation is sticking and going higher, as we see right now, then the Fed can no longer do that. And what we saw this week is the probability of Fed rate cuts going down in 24. The expectations were, oh my God, the Fed is going to cut rates by Q1 of 24. Then they pushed it to May, then to June, then July, then September, and the odds keep going down that the Fed will not cut rates absent of a financial disaster, a crash of some sort. Absent of that, there are no cuts coming. As a matter of fact, rates will continue to go higher, and rates are going higher. Back in the month of July, I made a video and I said they're lying. Rates will explode higher and more banks will collapse. Well, since then, you see what's going on with rates. What you haven't seen yet is the collapse of banks. And that may be near. And if rates are going higher, then the valuation in the stock market becomes even more ridiculous and more prone for big corrections and massive crashes. If we look at the valuations of the Magnificent Seven at 26.3 times, way too expensive right now. The Russell 2000 at almost 19 times, and even the S&P at 18 times is way too expensive right now, given the fact that rates are going higher, given the fact that we have a recession coming around the corner. But folks, if you're listening right now and you're not watching, what I'm showing right now is a chart of valuations of different groups in the stock market. And if you see S&P X Magnificent 7, so the S&P minus the 7 stocks, the valuation actually goes down from 18 times to about 16 times, which illustrates for you the over-concentration problem in the stock market right now. That the mania, the bubble, is concentrated in the largest stocks in the world. If they go down, they will take everything down with them. So now we go from the wall of worry to the wall of hope. China reopening, central banks pivoting policy, and of course AI. We know that now 2 items are gone. China reopening not happening. China is in a recession right now and in a period of stagnation. The Federal Reserve and central banks, you saw the ECB raising rates, maybe the BOJ, the BOE are taking a pause along with the Fed now, but it's not up to them. They're not in charge, inflation is. If they see inflation going higher, or they're going to raise rates higher. And now we know that rate cuts are not happening anytime soon. And if they happen, they will happen for the wrong reason. So what do we have left here in this insane bubble in the stock market right now? All what we got is AI. And what we have seen recently is all of these companies claiming to be an AI company, but there are no tangible results at all. No massive increase in revenues, no tangible increase in profits, no plans, just empty promises. And these stocks are going down now. One company that allegedly delivered, showing massive increase in revenue, massive increase in income, with magically no increase in cost. But is the explanation behind all of that is back ordering, FOMO by companies by just double ordering these chips, overpaying for them, but as they see the economy around them slowing down, are they about to cancel or walk back from the commitment of buying chips from NVIDIA? What we know right now is the stock lost about $180 billion of its value in the month of September so far. What we know is the CEO has been dumping over $100 million worth of shares as of late. And what we know is that we have news of large companies such as Microsoft reducing orders from NVIDIA's H100 AI chips as they now look into producing all of these chips in-house. And many other companies are rumored to do the same. So if we go back to the explanation here that yes, the revenue by NVIDIA is real and the income is real, and the fact that cost did not go higher is due to the pricing power. And this is bad news, even if NVIDIA's revenue is real, because it tells you it was a transitory period of outlier demand. That's all there is. And now we're coming back to reality. And as we come back to reality, and the only hope and the only stock holding the market right now starts to lose its allure, what's going to hold this market right now? As we see the Magnificent Seven, ironically, of course, as we know in the movie, at least 4 of them get whacked. Now we see a lot of these Magnificent Seven names also getting whacked. And it leads us to the market that we have right now. Everybody's brushing off the weakness that we see recently in the stock market due to the seasonality. Oh, it's just the September seasonality playing out. You watch, after we get out of September, money will come back in and the stock market will go higher again. Wishful thinking, maybe. What if this is real? That the hype is over? Inflation is not really going down. The Fed is not really going to cut rates anytime soon. And if they do, it's going to be for the wrong reasons. China's economy is actually collapsing. And oh, by the way, the AI hype was indeed just a hype, and it's gone now. And the fiscal policy's hand will be tied because interest rates are higher. Inflation is not going down, and the interest payment for the government will continue to go higher and higher and higher. And oh, by the way, the Fed cannot really rescue the market by cutting rates because we have a stagflation problem. Commodities prices are still high. What if the stock market realizes that we are indeed in this reality? Then we start talking about, is it going to be? Is what we're seeing right now the beginning of a volume-geddon/87 type crash? Or are we about to see an oversold rally at least, and a revival of the hope? Let's make the case for both. We know the case for a crash is, if we look at the 2018 volume-geddon scenario, what you're looking at right now is the inverted chart of the 10-year in orange. So when the chart goes down, it means that yields are actually going higher. And then in white, the S&P 500. Now, these two charts should be rising together and going down together. You're not supposed to see big divergences as we see in this case right here. You see the orange line, bond yields, began trending down at some point, meaning rates were going higher. But the stock market was going higher too, ignoring the fact that bond yields were going higher. But then when bond yields made a new high in the pattern and broke out, That was the moment when the stock market realized, okay, I'm doing something wrong here. And we saw the volume getting crash. 87, it's the same thing. These two charts should be rising together or going down together. But what we saw in 87, impulsive market rally, as yields in this chart, the 10-year, the inverted chart going down, meaning yields are going higher. In other words, the market decided to ignore the signal from bond yields until what? Until a new high in the pattern was formed. That was the inflection point when we saw the market crashing. And we got the famous 1987 crash. This is what we look like today. The charts, as they're supposed to, were trending down together. But then around the month of May, we saw a massive divergence. And it continued all the way. As you see in orange, the chart went down, meaning rates were going higher. The chart in white was going higher, meaning the market was going higher, in defiance of bond yields. Until what? Until the 10-year began making higher highs. Then we started to see problems in the stock market. So maybe after all, it's not the seasonality. It's actually something more. And if bond yields continue to go higher, who's to say we're not going to have what would be the famous 2023 flash crash? On the other hand, the case for an oversold rebound and not a crash. If you're looking at the chart right now, you say, Maverick, is it going to be a crash or is it going to be an oversold rebound? And then we'll see. The case for an oversold rebound, look at the technicals here. I'm giving you one example, which is the chart of Boeing, a major Dow component. And it is now severely oversold. So there is a case, if you look at this chart, that we got to at least rebound from here. We can't just crash. But perhaps the better evidence for the oversold rebound case is actually the seasonality. If we look at the historic seasonality for the month of September, we know that the ugliest day is the 14th trading day, which was last Thursday. And it was an ugly day. The indices went down by more than 2%. But then as we head to the 16th trading day, which is this coming Monday, we usually see a rebound, led by the Dow Jones. But the problem is, after that, we see the market going down again, after an oversold rebound. And as you will see in the charts in a minute, the longer-term charts, the weekly charts, suggest that we have more pain to come. The shorter time frame charts, such as the daily charts, for example, they suggest that we're going to see an oversold rebound. Now the question is, what if it's not either or? What if it is both? What if we get an oversold bounce and then we crash in the month of October? That is something you got to keep in mind. But with that, folks, let's move on to cover the stock market information for you. And we begin with the closing of the indices last week, and here we go. On Friday, the Dow was down by 106.58 points, or a decline of 0.31%. The Nasdaq in the red by 12.18 points, or a decline of 0.09%. The S&P in the red by 9.94 points, or a decline of 0.23%. The sectors flattish for the most part, but the only sectors closing in the green, energy and technology. The laggards, led by real estate, financials, and defensives. We contrast this with the weekly theme, and here it is. Everything is down in the red, led by cyclicals, real estate, and materials. Defensives, energy, healthcare did a little better, but by a little better, I mean down 2%. I mean, this is how bad it was. Now, when we look at the breadth, we see that a little improvement over the previous session, but still negative. The NYSE, 41% advancing versus 57% declining. The Nasdaq, 39% advancing versus 57% declining. So getting close to neutral here. Maybe a leading indicator that indeed the advance to decline ratio is going to improve as we head to the seasonal rebound beginning Monday. But let's move on to commodities. And for Friday, it was a quiet session for commodities, mostly in the green, but we see some red here, beginning with natural gas down about 7% on Friday. And it was volatile for the week. We got some news from the EIA, some new data. Not all good, some bad. But for now, natural gas will continue to be volatile due to the weather forecast. As we head closer to the winter season, we're going to start to hear more and more news about, it's going to be warmer, it's going to be colder, and this is going to move natural gas futures up and down. Then we have coffee futures down about 3% on Friday, but it comes on the heels of big gains in previous days. Muted reactions in metals, mostly positive, and then we look at grains, mostly positive again, but for the week, most commodities were down, but the exception is OJ futures, and orange juice continues to be perhaps the only true AI. But folks, let's talk about grains here, and specifically wheat. I will bring back a favorite segment called Sticking It to Putin, Brah. Sticking it to Putin, Brah. You see, before the war even began, in December 21, I made a video and the title is He's Acting Crazy and It's Getting Scary. And we talked about that this war, if it happens, and I said it's going to be in the bag that it's going to happen, a huge part of this war is due to commodities, and specifically gas and wheat. I mean, do we think it's a coincidence that the Russians are capturing the largest producing regions of wheat in Ukraine? I don't think it's a coincidence at all. If we talk about, Saudi Arabia and OPEC Plus have a monopoly over oil, well, guess who's getting a monopoly over wheat? The answer is Russia. So all of this talk about, the sanctions and the war is good because we're sticking it to Putin. Well, apparently we're sticking it up our own asses. You got Germany now in a recession. You got, all of a sudden we're making Russia the king of wheat. The headline reads, Australia faces further wheat crop losses as September heat dense yields. So the crop in Australia down. We talked about the crop here in the US down. What is the replacement here? Well, the headline from the Financial Times reads, wheat prices fall as bumper Russian crop replaces Ukrainian supplies. Well, you might say, but Maverick, it's good. Prices are going down. Yeah, they're going down because Russia has a monopoly now. They own all of the wheat. They're producing more wheat. If you own the breadbasket of the world, literally, you think you're going to make more enemies or they're going to come back kissing your ass, begging to be friends. To eat. That's the leverage that we gave Russia. Investors initially feared the Kremlin's decision to pull out of the agreement in July, which sent prices soaring again and pushed millions into hunger. However, Russia's own wheat export have unexpectedly helped fill the gap left by the shortfall from Ukraine. So Ukraine loses money, Russia makes it. It takes market share away from Ukraine. Ukraine, which accounted for 9.2% of global wheat exports in 21 and 22 season, the last before the invasion. That is expected to fall to 6.4% for the 23-24 harvest season, according to the S&P. By contrast, Russia, already the world's largest producer, is set to supply 22.5% of global exports for the 23 and 24 harvest season. This is up from 15.9% in the 21-22 season. Listen to this. Ukraine's loss has been Russia's gain. Russia's surplus has also offset fears of falling yields in other major wheat-producing countries. Last week, a U.S. government forecast on global output for the 23-24 season revised down targets for Argentina, Australia, and Canada. Sticking it to Putin, you say? On to the big casino, the options market. What do we see here on Friday? The volume was higher, at least for the three popular names, Tesla, Nvidia, Apple, major moves, at least in Tesla. We now see puts outweighing calls in major names such as Nvidia, such as Meta, such as AMD. This is a major development, folks. And now we see traders betting against these companies, not for them. And we see the 5-day put-to-call ratio moving higher as I anticipated, and if it plays out the way I see it, we're going to see the put-to-call ratio, the puts that is, exploding significantly higher. We're going to get to extremes when it comes to the put-to-calls ratio, and then that would mark a perhaps more of a tradable bottom. And the VIX at that point would have already exploded significantly higher, and now it begins to pull back. But we're not there yet. So when we talk about is it going to be an oversold rebound or is this the beginning of a crash? This indicator alone says that we're heading for a crash, regardless of the oversold rebounds. Now, when we look at the unusual activities that took place in the options market on Friday, I'm not going to go over them, but I want to spot some themes here. So you see the SPXX, this is the 3 times bearish index for the SPY. SPY goes higher, SPXX go down. So somebody's buying puts on those, at least in the short run, anticipating perhaps an oversold rebound in the SPY. Then we look at the TBT. Now think about this as the inverse of the TLT. It's just 2 times. So when you're buying calls in this, you're betting that bond yields on the long end will go higher. If you're buying puts, you're betting that yields on the long end going down. Well, somebody's buying puts here, at least in the short run. What is the theme here? Betting that at least in the short run, we will see yields going down and the equities market recovering in an oversold rebound. And then whatever happens after that happens. Moving on to the heat map, what do we see here? This is the heat map on Friday. Again, it's a mixed picture. Mostly down day. Across the board, banks down, healthcare down, industrials, utilities, real estate, defensives, all down. Some positive rebounds in energy, some rebounds in technology and chips, in the Chinese names. But of course, the most notable activity on Friday was Tesla. The stock was down by almost 4.20%. And to me, Tesla and Nvidia are momentum indicators for the market. It's the crowd favorite names. They buy calls and puts on them, but they're mostly for these names. They usually buy calls. They're usually a stockholder or shareholder of Tesla. So when we see these names, in this case Tesla down by over 4% in a single day. Now you're going to question the momentum, and most importantly, question the appetite of dip buying. How reliable and sustainable dip buying is in the stock market right now. Because we're going to see an oversold rebound absent of a crash, and the question now becomes, would it last? Well, if the dip buying appetite and the risk-on sentiment by the momentum indicators such as Tesla and Nvidia, the popular names, if this indicator says that we have weakness in the momentum and lack of appetite of dip buying legitimately here, then whatever oversold rebound we get, it's going to be a dead cat bounce, and it won't last. We have another shoe to drop here. When we contrast this with the weekly heat map, what do we see here? A sea of red paint across the board, few exceptions in healthcare such as Amgen, such as the health insurance names United, Humana, some medical companies such as McKesson, some insurance companies did pretty good, PGR, Progressive, but besides that, the market was weak all across the board here. But of course, the notable exception from the weakness is Apple. We see relative strength here. It closed negative for the week, make no mistake here, but it outperformed. On the way down, Apple led. Apple was bleeding alone, but it was the leading indicator. The stock market will bleed too, and indeed it did. So the question now becomes, is Apple calling a rebound? Apple outperforms this week. Finds perhaps a bottoming ground, at least for an oversold rally. Is Apple the leading indicator that we have a case for an oversold rebound, and the sustainability of this rebound and the leading indicator for this rebound, whether it's going to last or not, is the performance of Apple? This is something you got to keep in mind here. It's really important. And I know you didn't listen to me, but you should have. When we contrast all of this with the weekly heat map for the ETFs, what do we see here? Pain across the board. No exceptions here. Of course, the inverse indices did pretty good. The VIX proxies, silver did pretty good. But besides that, it's a bloodbath across the board. Usually, when we see indiscriminate selling with no theme really working out here besides maybe panic, then usually it is an indicator that a rebound is coming. But as we've seen in the crashes of 2020, 2009, 2000. It could also be a leading indicator. The stock market itself is breaking, and therefore there is no mercy here. There is no theme, there is no exceptions. The market is breaking. It's a mechanical/fundamental break here. And this is why, my friends, I say that you gotta buckle up here. Interesting things will happen. And for that, let's look at the charts and then wrap it up. We begin with SPY. The S&P 500, an hourly chart, what do we see here? We talked before about the importance of 430 as support, and we got to 430, and we closed a little above 430. But throughout the day on Friday, as we talked on Thursday's video, the risk is if the market gaps higher and trades positively for a little bit, and then work out the oversold, I should say extremely oversold conditions on the RSI readings, then that's going to open the path for another shoe to drop. The question now becomes, do we stop here at 430, which is a really important number, or do we drop more? And if we drop more, how far can we go? I would say 430 is supposed to be solid support, but if it doesn't hold, then we have to zoom out the daily chart. And what we see here in the SPY is we lost the 20 daily moving average. We lost now the 100 daily moving average. And if we continue to head down here, then I have 426 as the next support. But if we look at the daily chart for the E-mini futures, what do we see here? Number one, the momentum is now negative. You look at the RSI, you look at the MACD, we have negative readings. Number two, it was an ugly closing candle. And the reason is it retested 4,384.5 as support and as resistance. And it failed them both, which means the chart is seeking a lower ground for support. Well, we have 43.50. We'll see how that's going to hold. And if it doesn't hold, then we have to go down to 4,300. Then we'll look at the SPX, the cash index. What do we see here? We lost the pattern. We formed a lower high. We formed an inverse ABC pattern. We lost plenty of support here. We have negative momentum, but is it about to become oversold? The answer is absolutely yes. And what if we go down to 4,300 and then the chart becomes really, really oversold? I think at 4,300, the algos will be triggered to buy and we see an oversold rebound. It doesn't have to happen this way, but this is perhaps an ideal scenario. What's not ideal is if we clean up the chart and we plug in the Bollinger Bands 20 and 100 MA in blue, we lost all of the moving averages. We're now below the 100 moving average, which is bearish, not bullish. But then you look at the Bollinger Bands, we're now trading outside of the Bollinger Bands, which means we're getting oversold here. It's becoming a little excessive, and there's at least a potential for an oversold rebound. But the damage has been already done. If we look at the weekly chart for the SPX, the cash index, what do we see here? We have negative divergence on the RSI. We have negative momentum showing up at the MACD indicator. If you look below the RSI, we have the vortex indicator now. The line in red tracks bearish momentum. The line in blue tracks bullish momentum. It appears that we're crossing now. In other words, the bearish momentum is taking over, and that will be a confirmation. And frankly, the confirmation is already here. We lost the 20-week moving average. That is bearish, not bullish. And perhaps the chart is forming an inverse ABC pattern. And the next support would be the 50-week moving average at around 4142.59, at least as it stands right now. Then we'll look at the 3-month chart of the SPX. We don't look at the 3-month, but in this case, we're gonna. The question now becomes, are we forming an inverse ABC pattern on a larger scale? If it is, then the top is already here and we have a crash coming. We look at the Qs, the NASDAQ, and hourly chart. What do we see here? We are now flirting with an important support line, which is 357. The problem is, on Friday's session, we saw consolidation and a little pop higher, at least in the morning, and that took care of the extremely oversold conditions on the hourly RSI, which means it opens the possibility for more pain to come as we open on Monday. How far can we go? Well, you got 357, that's strong support. If that doesn't hold up, then you got the low from August, which is around 354.71. If we zoom out to the daily chart for the Qs, you can see that 354.71 is a solid support here. It was strong resistance before. It was strong support in the month of August, and now we have to see how it's going to hold up. But the problem is when we say that the damage is already done, yet we have to wait for a confirmation here that it's over, and 354.71 is the most important line. It is due to the fact that we have a topping head and shoulder pattern, but it's only confirmed if we have a loss of 354.71 as support. Now we clean up the chart, we plug in the Bollinger Bands, 20 MA in white and 100 MA in blue. Folks, we lost the 100 now. This is not good. You can put a lipstick on a pig all you want, but this is not good. This is not bullish. This is a precursor for more pain to come. And if there is more pain to come, and if we lose 354.71, then we have the support of the gap. And if that happens, then we're going to lose the entirety of the rally since the month of June. And that would be a downside of an average of about 6.5%. Now, there's also an important line here on the weekly chart, which happens to be the top of the bear market rally back in 2022. The bottom line is, maybe we're forming an inverse ABC pattern all the way down in the retest to the top from the last bear market rally in 22. And that is confirmed, by the way, in the momentum indicators, RSI, negative divergence, the MACD indicator, a negative momentum. The vortex indicator is now giving us a confirmation that indeed we lost the bullish momentum and we're heading toward bearish momentum, which supports the flush down scenario. You look at the futures, the same thing. We're losing momentum here. RSI, MACD, ugly closing candle. Why do we say that? It ran a retest to 15,000 and closed at the low of the day, which means it needs to go down to the next support, which is 14,675. If that doesn't hold, then we got around 14,450. You look at the NDX, the NASDAQ 100 daily chart. What do we see here? Loss in momentum, loss in the moving averages. So we're now done with the 100 days moving average. And if the stock market here, in the case of the NDX, collapses, then we got support of the top from the bear market of last year, and that will be at 13,720.91. That will be a downside once again of about 6.5%. You look at the leading indicator, the SMH chips. What do we see here in the daily chart? We lost everything here. The 20, the 100 days moving average. But the chart right now, one could argue, oversold. We have a chart that is trading below the lower Bollinger Bands. We got a little bit of a rebound on Friday, but it doesn't say that we're not going to go down again. If we switch to the monthly chart for the SMH, the CHIPS index, we have what it appears to be the maverick top. And if we go down big, we have 123.53 as support. And then after that, I assume it's going to be a crash all the way back to the trend line. What about the Russell 2000? Some would argue a leading indicator, the IWM. Once again, it's getting oversold here. It is bearish. We have a crossing of the 20 moving average below the 100 moving average, but the chart is trading outside of the lower Bollinger Bands. The RSI is getting a little oversold here. We have support at 167.24. My call is we see somewhat of a rebound. It could last a day, 2 days, 3 days, but then the pain resumes. I don't have to clean up the chart for you so you can see the topping head and shoulder, but it's here and it's going to play out. And perhaps a leading indicator is the KRE regional banks. Once again, weakening tremendously here, but is it getting oversold? Sure it is. The RSI is getting oversold along with the MACD. We have a chart trading below the lower Bollinger Bands. I would not be surprised to see an oversold rebound, but absent of recapturing these moving averages, the 100, the 50, the 20, without recapturing these moving averages, the charts are now becoming bearish, indicating more pain to come, despite the oversold rallies. We'll look at the dollar daily chart, and I know a lot of you asked about the mysterious wick that we've seen, massive wick down overnight. We've seen a similar pattern Sunday night on bond yields. It was erased, of course, but now we have the tinfoil hat theories that maybe that was a leading indicator that bond yields will pop. What if the massive down wick in the dollar was a leading indicator that the dollar is going to go down next? Perhaps. We know the dollar right now is at resistance. We know that the dollar is getting overbought. We know that the dollar is due for a retest of the 20 days moving average, be it via pullback or consolidation. But then you look at the weekly chart for the Dixie and it looks positive. It looks as a chart that's been going higher and it's not really overbought right now. And you can't say that this is bearish at all. What if it is in the process of a breakout? Breakout pop, it becomes really oversold. We see an event in the stock market and then we see the dollar going down. This is why we're now at a critical point that we could see an accident. We could see the amicable dollar goes down because it's overbought and we see the market rebounding higher because it is oversold. Or we could see a crash. You look at gold, the old man, what do we see here? It lost 1928 again. It doesn't mean that it's over. It doesn't mean that gold's supposed to go down now. It is actually forming a higher low. But in a week where the dollar pretty much traded higher, we also saw gold going higher. So there's a poker game here. Somebody's lying, either it's gold or either it's the dollar. If the dollar is lying, then it goes down and we see a big oversold rebound. If gold is lying and the Dixie is going higher in an impulsive fashion, then the equities market is going down, perhaps in a crash scenario. Then we plug in the Bollinger Bands for gold, we see that it is a little below the 20 days moving average. So a little bit of weakness here, but it doesn't say who won and who's winning the poker game. We'll look at the SLV silver daily chart. What do we see here? We got a pop higher. It appears that we have a rejection at the 50 MA. The chart did not lose the 20 MA yet, so again it is inconclusive, but the rejection of the 50 is really important. On the other hand, keeping the 20 is also equally important. So there is no clear or obvious decision here. The poker game continues to go on. Then we'll look at Brent oil. What do we see here in the daily chart? We have loss in momentum confirmed now in the RSI, in the MACD, but so far it's happening in an amicable way. We see the prices of oil going down, about to kiss the 20 days moving average, but not in a massive flush down, just a little pullback for now. The chart of oil definitely looks a lot better than the chart of the stock market right now. Then we'll look at the XLE, the ETF for energy. What do we see here? Lost the 20 days moving average, but the good news is above the 50, above the 100, and most importantly above 89.14, which is an important line of support. But look at the RSI. It's not really oversold on the daily chart as we see in technology stocks, for example, or the indices. So the question now becomes, if the indices rebound, will the XLE rebound from this point here? And if it does, then it is a sign of strength in oil. What we could be seeing is we get an oversold rebound in the indices, then they flush down again. Yet we see energy stocks holding these gains as we see energy prices going higher again. And we look at the daily chart for the 2-year yield. What do we see here? We're at the highs now. And on Friday, it was down, but we saw a retest of the highs, now support. But we got a rebound, indicating that the 2-year is, at least for now, wants to go higher. We look at the 10 and we use an hourly chart. The case for yields going down, at least the 10 and the longer end, is are we seeing a formation of a topping head and shoulder, at least in the hourly chart? And we see a pullback in the 10 and equities rebound, be it an oversold, be it a dead cat rally, who cares? At least it's a rebound because yields are going down. On the other hand, we know that in the daily chart, the 10-year is on a breakout. It became a little overextended here. If you look at the RSI, we got a pullback on Friday, but there is no signal here that it has stopped or it's reversing down. Look at the 30. Big breakout higher. Again, it dropped down on Friday by a little bit, but it remains in a breakout, indicating that yields are going higher. And as the 30-year bond yield went higher, look at what happened this week for the IYR, the real estate index. Massive flush down. The head and shoulder topping pattern played out. And folks, it was the most profitable trade this week. If you shorted the IYR, it produced gains north of 1,000% this week alone. Then we look at the ITB for construction. You can look at the XHB. Again, you can see the damage here. The question now becomes, are these charts becoming oversold, too oversold, and due for a rebound? Perhaps. But that's only going to happen if we see the 30-year yield going down. Then we'll look at the VIX daily chart. What do we see here? You know, at some point on Friday, I thought maybe the VIX is topping here. It's getting overbought. It might go down, and that would be a leading indicator that we have a rebound coming in equities. But then by the end of the day, we saw a massive rally in the VIX, and the close was above 17. And it was a bullish candle indicating that we have more gains to come for the VIX. So if we look at the VIX alone as an indicator, it says that we have another pop coming, another big drop, and then the VIX becomes really overbought, equities become really oversold, maybe at 4,300, for example, on the S&P 500. And we see a rebound. Whether it's going to last or not, you saw the weekly charts, and the weekly charts say, unless it's a massive rebound, it's not going to change the outcome here, that we're going down. The big kahuna Apple hourly chart, what do we see here? The good news is, it is keeping 173.54 as support. The other good news is, it could be forming an ABC pattern. And maybe the VIX is a leading indicator for the bears in the stock market. Maybe Apple is the leading indicator for the bulls. That Apple may be bottomed here, and it's ready to go higher in an ABC pattern. And as Apple goes, so will the market. Here's the bad news for Apple. What if this is a formation of a lower high? And if we zoom out to the daily chart, we lost all of the moving averages. It was an ugly candle on Friday, closing at the lows. And if we start to go down and we lose 173.54 in this chart, then we have to go back to the weekly chart. What do we see here? If we plug in the 20 moving average, we already lost that. We have the 50 in blue. Maybe the chart is forming an inverse ABC pattern. And the next stop is the 50 weekly moving average, which stands right now at 162.72. Tesla, an hourly chart, ugly day on Friday. The question now becomes, is it too oversold, due for a rebound? And if the answer is yes, who gives a shit? And the reason is, you look at the daily chart, you zoom out, you've already have a confirmation of loss in momentum. The RSI negative divergence, the MACD is now showing us negative momentum. If you look at the moving averages, we have a closing on weekly basis below the 20 and the 50 moving averages. This is a confirmation that we have a loss in momentum. Now, if we plug in the 100 daily moving average, what do we see here? Maybe that's the next support. And right now it stands at 238.29. But for now, Tesla turned negative. A lot of you, when we talked about the chart on Thursday, we said if it closes below the 50 and 20 moving averages, we have a double confirmation. And the algos will be on your side. And this is why Tesla went down by more than 4% on Friday. You can pin it on any piece of news you want, but it was an algorithmic reaction to the double loss in moving averages. Furthermore, when we zoom out to a weekly chart now, what do we see? We see a loss in momentum in the RSI. We see a loss in momentum in the MACD indicator. The Vortex indicator is also pointing out that the bearish momentum is about to take over. It is now trading above the 20 moving average on the weekly chart. But the bad news is, what if it loses this support line in an inverse ABC pattern? The next support would be 50 weeks moving average, and that's at around 203.33. NVIDIA daily chart, what do we see here? It is now flirting with the 100 moving average. Can it go a little down? Yes, we can. We can go down to 405. That's support, but the RSI will become really oversold. And now we have the risk of a rebound, an oversold rebound. Yet the damage is already done, folks. If we switch to the weekly chart, what do we see here? We lost the trend line. Number one. Number two, we lost the 20 weekly moving average. Number three, we have loss in momentum. Negative divergence in the RSI. We have red impressions in the histogram of the MACD. And we have a crossing, it appears so, or at least coming, on the Vortex indicator, where the bearish momentum is taking over the bullish momentum. If that is the case, then it's just a matter of time now. The stock becomes really sensitive to any bad news. And if we get any confirmation that the numbers that NVIDIA gave out are not going to hold up due to accounting reasons, due to fundamental reasons, due to canceling orders reasons, doesn't matter. If the headline hits, you see a massive reaction to the downside. All of the algos, all of the mechanics, they get triggered at the same time. We see an oversized reaction to the downside. And if NVIDIA goes, who's going to hold the market here? Let's be honest, nobody. Lastly, tulips, Bitcoin, daily chart. What do we see here? The answer is nothing, consolidating. So we're going to move on. And we move on to the conclusion of this video. What do we have on the economic calendar this week? Monday, we have nothing, so it could be a good day for a rebound. But Tuesday, the 26th, we have new home sales. We have the chiller home price index on top of consumer confidence and Fed Governor Bowman speaking. Wednesday, the 27th, we have durable goods. Thursday, the 28th, we have initial jobless claims. We have a revision for the GDP. This could be a big one. And then we have Governor Cook speaking along with the big dog, once again, Chairman Powell, with a cleanup job. But he better be careful what he says, because Friday, the 29th, we have personal income, personal spending, and most importantly, the PCE inflation index. That comes on top of retail inventories, wholesale inventories, the Chicago Business Barometer, and from the University of Michigan, the final reading of consumer sentiment. Folks, it's a long show. Hope you enjoyed it. Love you all. Hope you're having a great weekend and you're ready to go next week. But for now, this is all I got for you. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
You just got to be sharp, stay focused, answer the questions correctly.
That's right. We're good. Right, I've successfully had an act of God added to the NTSB's list of probable causes. We've shifted suspicion away from you. It's no longer a question of your condition, but the condition of the plane.
That's what I've been trying to tell everybody.